Welcome to Traders and Investors Group. It's the 4th of April 2019. Let me start with a picture of the S&P 500, and as we have discussed many times over the previous months, and that is that the S&P 500 is in the context of a pattern evolving into, or has evolved into, an inverted head and shoulders pattern, which is currently completing its right shoulder. The market also has, in the past few weeks, traded and closed above its neckline, which is the beginning of a medium term, potentially a longer term breakout into the, not the distant future, but looking forward months into the future. For those of you who have been sitting on the sidelines, waiting to be sure that this market is accumulation by definition is absolutely complete, and it's now time for the market to do a steady series of high highs and high lows, as it did, if you recall, back last year from approximately the same time. Let's quickly go back, just shifting the chart. Back in April last year, we had an expansion which went from April through to September, avoiding any major disturbances in May. And that was one of the largest expansions, or it was the largest expansion last year, and that's what may happen again this year. There is no fundamentals stopping it. Brexit, the four fundamentals that are affecting the market globally are Brexit, China, North Korea, and the often mentioned yield curve. Brexit, ongoing chaos. It is in no way affecting UK markets. We'll have a look at those in a moment. China is a positive story where we can see, technically speaking, China has bottomed and starting to make major upside moves. North Korea is a topic on hold, and the yield curve is the scare story that's trotted out every few months, but it's really, because of its long lead-in time, is not irrelevant to this discussion. In the context of the S&P 500, we not only like to look at price behaviour, but we also look at institutional volume behaviour, and in particular, some of the internal volume numbers, which are, I suppose, supporting the contention this market will continue to the upside. The most important numbers I look at are advancing and declining stocks, and 3 weeks ago there were, within the S&P 500, 261 advancing stocks, 212 declining. Last week, 247 advancing, 226 declining. This week, 287 advancing, 186 declining. That's a major shift from last week, but last week we were in the midst of a pullback, so that's not surprising that the last week numbers, they backed off a bit. As I've said many times, the most important metric is not the numbers themselves, it's the volume of the numbers. And I can tell you that the advancing stocks, in terms of volume as of Wednesday evening, or Wednesday close of business, are doing a volume which is 66% above declining volume. That's the fuel that drives the numbers. That's the most important metric, and it supports the contention of ongoing expanding equity markets. In the context of new highs, new lows, we have 3 weeks ago 30 new highs, 2 new lows. Last week, 34 new highs, 2 new lows, and this week 37 new highs, 2 new lows. So these are breadth measurements, and both the breadth measurements are supporting, once again, an ongoing break out of this neckline of this pattern, ongoing expanding markets. There's also other metrics I look at, and that is trading, institutional trading volumes, and they are quite positive and actually have just turned quite positive in the past week. My forecast for this particular market is that we're due for a small pullback. The market is slightly overextended. If we just zoom in on the chart and look at the price action in relation to the moving average, markets don't go too far above that moving average before they have to come back. They mean revert. There's a natural rate of change of price within the S&P 500. It's too high at the moment, so if I was looking at purchasing equities in the next session on the open, I probably wouldn't do that. I would wait for this market to have its pullback, which is anticipated within the next few days, next week maybe. It may be a very small pullback, so be cautious. and then the market will continue on its way. Other indices that we continually like to look at, but not as important, I suppose, is the mid-cap IWM, Russell 2000. Looking at the Russell 2000, I drew a support line underneath the left and the right shoulder. The market came and fell exactly onto the right shoulder. As it touched the trend line, it bounced 2 weeks ago. This market had completed what I would describe to you as a three-wave structure, which is about to be confirmed as the market breaks into a new low. Breaks into a new high as it breaks above this previous swing high. That may not be confirmed in the next session or so, because I'm anticipating a small pullback, but in the next 2 weeks, that's what should happen. And this market has continued on its way, building its left and right shoulders, technically speaking, and it's all extremely bullish. Let's go and consider other indices around the world which paint the picture of, for the first time in many, many months, of a synchronized global bull market. The most important markets we look at are China, Europe, both the FTSE and also the DAX. We look at the Australian index, and for the first time, I'm going to start introducing the Canadian index. I'm just going to stick with using an exchange-traded fund that represents Canada, traded on NYSE, and hopefully that will suffice to get a good technical picture of what's occurring. Let's start with looking at European indices. Let's come across to EWU. I'm going to contract this picture up. So you've got a long-term view of a market that has been declining, factoring the negativity from the Brexit discussion. Now, we can obviously see Brexit is in no way and will in no way affect what's about to happen. And that is the negativity has already been factored in, and global portfolio managers are rebalancing their portfolios into UK stocks. Hence, we've got this strong rally in UK stocks. So what we can see, technically speaking, in the last 2 weeks is a stronger series of higher highs, higher lows in the last few nights, a gapping, which is using the 20-period exponential moving average as a line of support. It's bullish to the extreme. Let's come across to EWG, which is Germany. Looking at Central Europe, do we see any large picture of negativity on screen? I think not. The market has been declining, and I could do a number of different trend lines, but at the base of the screen, as I blow it up, what I will observe is that there is a completed inverted head and shoulders pattern, which is an accumulation pattern. The market in the last 4 weeks has broken trend and is doing a series of higher highs and higher lows, with the market gapping in the last few sessions. This is bullish, not bearish. So whatever's happening in Europe is not really factoring in the market. Once again, all the negativity that has occurred within the European scene has already been dissipated, and the discussions can continue, but the market has factored it all in. Hence, we are continuing on the way up. We can look at a broader or a more exact picture of the DAX, which I do have on screen, and it is a same thing, inverted head and shoulders pattern, with the market breaking up very strongly in the past week. Let's come across to Canada, which I nearly missed. And once again, it's the exchange traded fund representing Canada. It's the iShares EWC. What can you see on screen? After a steep decline along with US markets, we have seen an inverted head and shoulders pattern. It's completed its left and right shoulders and is currently in the process of breaking its neckline. We could adjust that very slightly. It hasn't quite, I suppose, broken its neckline, but what have we got on screen? Technically speaking, a series of higher lows, series of higher highs. This market is all set to make a big push. Double test, which is close together. That's in the context of an ongoing bullish pattern, is very, very interesting. So EWC and all the European markets, although they have had a period of decline, are now synchronized to the upside. But that's not the complete picture. Let's come across to the Asia Pacific First of all, let's look at the FTSE. Once again, I'm using FXI trade on NYSE, and it's been in a long-term decline. We are well aware why this decline has occurred. It's due to renegotiation of trade deals between the United States and China. But as those trade deals have progressed to the positive, I believe, of the United States, finally, we can see a large accumulation pattern in the form of a W pattern. Market's broken trend is now doing a series of higher highs and higher lows. There are industries and sectors of the market that are highly correlated with FXI or highly correlated with China, and that's metals and mining. So if you start looking at metals and mining, especially within the Asia-Pacific context, we're seeing some major moves in BHP, which is traded in our region. Coming across quickly, I've got the Shanghai Composite chart. Looking at the Shanghai Composite chart, we see that it has just exploded to the upside and continues to explode to the upside. Once again, it reflects the same as the exchange traded fund chart. It's been declining dramatically, large W pattern, and then we've got this explosive move to the upside after a strong and protracted decline. That's all over. So we have many of these markets, after severe declines all through 2018, are now pointing to the upside. The last chart for the indices I'll do is a local chart. EWA, first of all. EWA is the chart which represents Australia within exchange traded funds, trade on NYSE. Once again, inverted head and shoulders pattern. That sideways move is a time correction as against a price correction, which is a pullback. The time correction is very bullish, and you can see explosive moves now coming out of that particular contract. As it closes and trades above its inverted head and shoulders pattern. I can zero in on the actual local chart, which is XJO is the code. It's called the ASX 200, S&P 200, and this chart is a little bit messy. But in the past few weeks, what I've looked at is this market doing what I would describe as a three-wave structure. That three-wave structure, if I elongate the structure, just give me one moment, and clean up my chart very, very quickly. That three-wave structure, which started at the high, found resistance at 0.618 extension, down to the average, small bounce, there goes your three-wave structure. Three-wave structures are extremely bullish. So this is the first move out of that structure, and it's gone very hard and fast in the past week. Therefore, markets once again, which reside too far above their average, cannot stay there. They have to revert back to their average before they can continue, and that's exactly what we're observing in the context of this chart. It is absolutely no different to many of the other charts that I've described, and the S&P 500, I said exactly the same words. Just coming back to another three-wave structure on screen, not wanting to move too quickly, because I mentioned it last week, it was IWM Russell 2000. Once again, it's the same thing. There goes your three-wave structure. It's extremely bullish. Don't look at this and say it's broken trend. This is all very, very bullish, and we'll start to, make its move in the very near future. The primary driver of these charts is the volume that supports the move. And in every index that I'm looking at, I've primarily got volume institutional trading volume data for exchange traded funds. It is extremely positive and increasingly so. Therefore, I could only make the preemption that this market is about to continue its break to the upside for an extended period of time. The question is, can we do a forecast of how far or where that extension may go to? The answer is absolutely, and I've done this hundreds of times, so let me do that for you. If we're using technical analysis to project upward price movements, we can use the depth of patterns, and in this case I'll use the neckline of this particular pattern and the depth of the pattern to project its upward move using a Fibonacci extension tool. So just give me one moment. I'm just grabbing my tool, and I've gone and picked the wrong tool. Excuse me. Just going to grab the line, grab the bottom of the line, just grabbing it. Okay, so just looking as I contract up the chart. Generally speaking, this has got a high degree of possibility. The resistance level in which markets breaking the upside should reach is the first Fibonacci, which resides above a previous swing high. If I go to a weekly chart, just give me one moment, you can see that that level that I just marked up on my screen is 0.618, which is a division of the depth of the pattern, which is the most likely, not definitely, the most likely target for this market to make its move to. So it can do it kind of quickly. So this market is expanding, and I've got a target on screen. I'll reference that target many times into the future, and I've done this so many times, but it's not too early to start projecting where this market should head to, in the next months ahead. Okay, this was a reasonably short market forecast, just containing indices. I've got a group which we do a lot larger review, looking at gold and oil, currencies. We look at identifying the strongest sectors of economic growth in Asia Pacific and North America. We look for opportunities in specific sectors, and we look at oil, metals and mining, and that's what we're about to do in another session, but just making sure you know that's it for this particular recording, which was done specifically for Facebook. If you want to talk to me, you're most welcome. You can find me at paul@options21.com.au. That's paul@options21.com.au.